Hello and welcome to Investors Hangout, your weekly guide to making smarter financial decisions. This series is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. We have with us our in-house expert Dhirendra Kumar to help us navigate the current landscape of fixed income investment. Welcome, Dhirendra.
Thank you.
So, fixed income investing is often seen as a conservative approach. But in times like these, uncertain times when, with inflation, interest rates, global market volatility, how should investors be thinking about their fixed income strategies at such a time?
After a long time, there has been 2 rate cuts, and that has boosted the fixed income. Particularly, there is an inverse relationship between rate cuts and bond funds return. And longer the maturity of a bond, higher it gains the moment interest rates go down. So that is why we have seen that the long-term gilt funds or long-term bond funds, they have appreciated substantially in recent times. If you look at returns, they look very handsome. Every investor should have a fixed income allocation, primarily because, and I'm talking of fixed income allocation for the long-term investor. Like even if you're investing for 10 year, 20 year, 30 year, you should still have fixed income allocation. Though I keep saying that for your long-term money, you should have equity, but substantially equity. But nominally, every investor should have fixed income. There are a lot of conservative investors whose mainstream, their main portfolio, or all their investment is in fixed income. They don't have an appetite for risk. They are not comfortable with risk. They are not comfortable with volatility. They can't really withstand the ups and downs. And that is fine for them. If you have not experienced it, if nobody has taught you, if you haven't tried it, and if you could not really reconcile with the ups and downs of it, no point being there, because if you try and be there, you will only be hurt because you will behave in a fairly erratic manner. And that will, at least in fixed income, you are guaranteed some return. And here you will end up, buying something at the wrong time, then selling it at the wrong time, and, eventually you will not make any return. In fact, you'll lose a part of your capital. So I would say that every investor should have a fixed income allocation, and I'm talking of the long-term allocation. Short-term investment should anyway be in fixed income, whether it lies in your bank account or whether it lies in you put your money in a liquid fund, you put your money in a money market fund. The money that you need in a foreseeable future, 3 months, 6 months, 1 year, that should be in fixed income anyway.
But like you mentioned that in India, a lot of investors, they have only fixed income
They invest
investments.
in fixed income in yielding investments.
But as compared to investments in equity funds, what has been observed is that individual investors are not so comfortable investing in debt funds. Why do you think that is the case?
One is that it simply has a longer history. Most investors have been used to fixed deposits or post office deposits or post office, small savings scheme for generations. Even your, grandparents will tell you that why you should open your PPF account and be at it. So that is one is simply the legacy. The market is relatively new. Then comes, the stock market experience. In the past has been fairly erratic. People get attracted at the wrong time and they have been disappointed. And, we have a whole generation of investors who are disappointed with stock market, even through mutual fund, simply because ill-timed seasonal investments. Fixed income, or when you do a deposit, you may not get good returns, you may not beat inflation, but you never lose money, or optically you never lose money even if you don't make money. Easy availability of fixed deposit. Also the perceived risk. The large banks in the country or the public sector banks in the country is perceived to be virtually risk-free. The post office, the small savings schemes or the PPF or the senior citizen savings scheme, one, they are perceived to be risk-free and some of them are actually risk-free. Second is that they are also very high yielding. When you put your money in savings, senior citizen savings scheme, today it is the highest yielding guaranteed return scheme in the country. Not only that, look at RBI floating rate bonds, which individual investors can buy. And that is also, of course, it is floating rate, so it can come down. But, nevertheless, today it is also among the highest yielding fixed deposit, fixed income yield, investment. Besides that, one is fixed income, high returns, absolute safety. Even though, the investment in fixed income fund is very high, but that is primarily because of the company's investment, corporate investment in those funds. Because corporate companies don't have access to these deposits. Companies, when they put their money in the bank, it is generally a current account. Current account don't yield anything meaningful. So that money is lying idle. So they put their money in the liquid fund or the money market fund or the short-term bond fund, or so to optimize their return. They take a position in that. Individual investors, they haven't taken fancy to these fixed income funds. Yes, individual investors have now increasingly taking a fancy to the hybrid funds where you invest in your money and a small part or a large part is invested in fixed income. So, but you are basically taking a bet on a broader exposure, a more diverse exposure to optimize your return. But you are not buying fixed income per se, because the fixed income need is better fulfilled by decent return and reasonable safety. And when you get not only decent return, best return and absolute safety, then I think it's a no-brainer.
So now let's break it down a bit. What should the core of a fixed income portfolio or fixed income strategy look like at times like these?
One is to decide your own allocation. Assuming that you have a large amount of money which is to be invested in fixed income, then I think the simple approach should be that you should be investing a reasonable amount, substantial, or maybe a good part of it in short-term debt fund and corporate debt fund, high-quality corporate debt fund, because short-term debt fund, they don't take any big maturity risk. Any fund which is investing in AA and AAA bonds, don't slip below that. Don't slip below AA. Simply because the credit risk is not worth your while. Taking a risk where you put at stake your capital for sake of slightly higher return, it may not be. You may not be in for it. It might be present a nasty surprise, and that should be 30, 40, 50% of your money. Rest of it should be in medium term, but once again, never compromise on the quality of the credit quality and some duration where a fund manager has proven credentials of taking a duration risk. Maybe 10 to 15% should be in long-term maturity, duration calls, which is the long-term gilt fund or fund managers who have proven credentials of timing or having the knack for being into those bonds and being able to benefit from these rate cuts and being there opportunistically and being out of it opportunistically, because right now we are witnessing a rate cut. There will be a reverse of this, and then you'll be hurt otherwise. So being investing through a fund which has the flexibility to move completely out of those or reduce their maturity completely in a well-timed, organized fashion, and having a process to do that. And some funds have demonstrated track record of that. So I think this should be a simple strategy. Don't put your short-term money into any of these. That is liquid fund, money market fund, or your bank account, or your fixed deposits. The long-term money, investing maybe a third of it into short-term bond funds, corporate bond fund, and short duration funds. Second is 30, 35%, 40% should be into medium-term bond fund where you're taking some risk and some duration calls. 10, 15% should be opportunistically invested in long maturity funds, which are taking these dynamic calls.
We've seen a lot of rate cuts recently. If there is an investor who is trying to benefit from these rate cuts, what should he do?
He should try and target, gilt funds and dynamic bond fund up to a quarter of his money. Assuming you have 1 crore of rupees invested in fixed income fund. So 25 lakh rupees can be invested in gilt and dynamic bond fund. These are funds which will try and benefit, try and optimize your return from these interest rate changes. 25% should be in short-term, and corporate bond funds, because this is something which will provide stability to your, overall asset. 10% should be in liquid funds so that, you can increase or decrease your allocation when needed. And I'm talking of 100% investing in fixed income. Right. I'm excluding your equity allocation or any other thing. And 20-30% should be in target maturity fund, very much in line with your needs. If you need that money, and that's so 30% of your money should be in target maturity fund, aligning with your requirement, 3 years from now, 2 years from now, and you have these target maturity funds available today.
So what are some of the common mistakes that fixed income investors usually make, and how can they really avoid it?
individual investors generally make the same mistake which they make everywhere. They think that, this recent past performance, I have seen that most of the time they look at the returns of this gilt fund and the dynamic bond fund, and after a rate cut, these returns will look very handsome. And they think that they will invest their money and they will earn that. And for a while they do. But mostly successive rate cuts are, followed by rate hikes as well. And rate cuts and rate hikes normally come as a surprise. They never come with a notice. So what happens is, you look at this handsome return, invest your money, then you are faced with the rates going up, and then you see a big capital loss. And that is when they run for cover. And they run for cover, and for a fixed income investor, when he loses even a small part of his capital, even if he loses 3%, 4%, 5%, it is devastating, because this investor never thought that, these investments will go down in value. He never thought in his dream that, he's investing in a fixed income fund. They invest only in bonds. And why there is a loss? So, lack of understanding. And sometimes just chasing recent past, it's like rear view and investing and then going wrong.
So before we wrap up, what's your top advice for investors looking to build or rebalance their fixed income strategy in the current environment without overcomplicating things?
Consider gilt funds and dynamic bond funds. If you have zero allocation, allocate 10%. If you have 10%, increase it to 20%. If you have 20%, increase it to 30%. Don't go anywhere beyond that.
All right, now moving on to the viewer's question. Chandan Agarwal asks, can we earn some extra income on our mutual fund portfolios? Like someone holding direct stocks can sell covered calls with or use the securities lending and borrowing mechanism for regular monthly income. Do mutual funds also have such options or provisions?
No, you as a mutual fund investors don't have that. The mutual fund companies have that. That, your fund manager can avail their securities lending and borrowing mechanism. But I haven't seen, any meaningful return coming by way of this lending these securities, which is part of the portfolio.
All right, then. Thank you, Dhirendra.
Thank you.
If you found today's discussion useful, like and share this video and subscribe to our YouTube channel for more expert insights. Keep watching this space for more information. Thank you. Goodbye.
ये है मिस्टर सैनी और इन्हें है बड़ी बेचैनी। कुकिंग रील्स के बन गए फैन और बनाया खुद का कैफे खोलने का प्लान। जब साथ बने फ्राइड राइस, लॉलीपॉप तो कस्टमर बढ़ते गए नॉन स्टॉप। एक कैफे के हो गए 4, बढ़ता गया फैंस का प्यार। ऑटोग्राफ, सेल्फी, इंटरव्यूज, पर इतने में प्लानिंग का उड़ गया क्योंकि मिस्टर सैनी भूल गए उनका सबसे इंपॉर्टेंट प्लान यानी SIP। तो अपने ड्रीम लाइफ को सिर्फ डे ड्रीम मत बनाओ, उसे पूरा करने के लिए SIP स्टार्ट करो। एन इन्वेस्टर एजुकेशन इनिशिएटिव बाय आदित्य बिरला सन लाइफ म्यूचुअल फंड।
म्यूचुअल फंड निवेश बाजार जोखिमों के अधीन है। योजना से संबंधित सभी दस्तावेजों को ध्यान से पढ़ें।